This might be the trickiest mini lecture of this module, because what we're going to try and do in this lecture is go through the history, sort of internal logic of the development of neoclassical utility and expected utility theory. It's a story which has been told in many places, including in the first part of chapter 4 of my book, which there is a link to via the library at the end of this set of slides. So here we are, expected utility theory. We look at some of the historical roots of utility and expected utility theory as theories of well-being and decision-making, which define what it means to be rational in neoclassical or mainstream or orthodox economics. The idea that there is a concept called utility, which is a measurement of human satisfaction or well-being, and which we can measure, at least in principle, we can imagine being measurable on some scale, goes all the way back to, well, when we're talking about, suppose I eat a bar of chocolate, how much utility will that bar of chocolate give me? We can go all the way back to Jeremy Bentham, a very famous philosopher whose body is on display even today at University College London. His head used to be on display until students from King's College London stole it on a famous occasion in the past. It's now locked away safely somewhere in University College London. Anyway, utilitarianism is associated with Jeremy Bentham. Under utilitarianism, the value of any item or activity can be measured in terms of its contribution towards human utility, and utility is measurable on a cardinal scale. So you could say how many utils I would get from a bar of chocolate, how many utils you would get from the same bar of chocolate, and we can actually compare our utility between us and say who would enjoy the bar more and by how much, because utility is, at least conceptually, we're thinking about it being measurable on a cardinal scale. There, where our total utility from life depends on how wealthy we are, then we're going back to Daniel Bernoulli and a paper written by Daniel Bernoulli in 1738, when Adam Smith, I think he was alive, but would have been at primary school. Then way back, in other words, to the 18th century, before The Wealth of Nations was even written, Daniel Bernoulli was writing a paper on mathematical economics that looks very similar in terms of its content to modern expected utility theory, which is at the foundations of modern portfolio theory, the modern theory of finance, on which trillions of dollars are invested around the world, even to this day. Anyway, their contributions were about cardinal utility. If utility or satisfaction could be measured in utils, then we could make interpersonal comparisons of well-being and even guide public policy decisions based on the maximization of social utility, just by adding our utility scores up across the whole population. The notion of cardinal utility played an important role in the development of the neoclassical theory of consumer behavior, because if you are behaving as a utility maximizer with a limited income, you ought to be allocating your income to alternative goods and services in such a way that you get the same amount of marginal utility per dollar spent on the last unit of each good you buy. Otherwise, you should be able to reallocate your income away from some goods and towards others and increase the total amount of utility you enjoy. Well, all this, of course, is based on the notion that utility is in some sense measurable, despite the role of marginal utility theory based on cardinal utility in the neoclassical revolution of the late 19th century. Nonetheless, late 19th century economists led by J.S. Mill and others eventually moved away from notions of cardinal utility to ordinal utility because, of course, it's obvious our well-being is not measurable along some scale. It's not like our temperature. I can't put something, can't put a thermometer into your, or the equivalent of that into your mouth and measure how much satisfaction you're enjoying. Actually, there is some evidence in modern neuroscience that there may, at some stage, be some quantitative measure of well-being that has some degree of scientific validity. But even then, it won't be suitable for interpersonal comparisons. So it doesn't fit Bentham's approach to thinking about utility. In ordinal utility, to move away from something which is highly unrealistic towards something which is less unrealistic. In ordinal utility, if we're presented with two choices, A and B, a Mars bar and a Twix, then a decision maker can specify whether she prefers or is indifferent between them. She prefers the Mars to the Twix, she prefers the Twix to the Mars bar, or she doesn't care. But not how much more one is preferred. So you can't say a Mars bar will give me 3 utils more than a Twix. That doesn't make sense because utils don't exist. And interpersonal comparisons of welfare are meaningless. And this is where the very limited definition of what an efficient allocation of resources in an economy called Pareto optimality came from towards the end of the 19th century, named after Vilfredo Pareto. An allocation of social resources is described as Pareto optimal if you cannot change that allocation to benefit anyone without at least one other person being made worse off. In a sense, this is the best you can do when thinking about an efficient allocation of resources when interpersonal comparisons of well-being are impossible. But of course, it says nothing about the distribution of income, or it downgrades the distribution of income, because an allocation of social resources could be Pareto optimal if all the resources in the country were owned by one person. If you couldn't change that allocation to make anyone else better off without that one person suffering. It is the standard definition of allocative efficiency or economic efficiency in neoclassical economics. You have to be very careful when you hear a neoclassical economist talking about a potential Pareto improvement. They often use this language when justifying free trade deals. They'll say this free trade deal increases welfare because it generates over time a potential Pareto improvement. What that means is some people will benefit from this free trade deal. It creates opportunities for exporters. It will benefit at least some consumers who will be able to get cheaper imports. Other people will lose out. People may lose their jobs and become unemployed as a result of working for businesses which can't compete any longer against imports now that those imports are free of trade barriers, now that there's no tariff, no tax on those imports anymore to give the domestic producers a competitive advantage. If there's a potential Pareto improvement, what this means is that the people who've gained from the trade deal, in principle, could compensate the people who've lost out and still have some money left over after doing so. But of course, these compensations never actually happen. For potential Pareto improvements and actual Pareto improvements are not the same thing. An actual Pareto improvement is when some people in society get better off without anybody else being worse off. It's a concept, obviously, from ordinal utility. Paul Samuelson, who developed much of modern neoclassical economics after the Second World War and wrote what was for many years the world's best-selling economics textbook, and which in a sense is the parent of all neoclassical economics textbooks over the last 60, 70 years or so, wrote an important paper in the theory of consumer choice, in utility theory, in 1938, where he developed the concept of revealed preference. Now, I don't want to worry too much about what it says on this slide. If you find it at all confusing, it's not that important. What Samuelson did was he devised some axioms where if these axioms apply, as far as a decision maker is concerned, you can model them mathematically as though they are maximizing a quantitative measure of utility, even though cardinal utility measures don't actually exist. So even though utility is not measurable, people will behave in a way as though it is measurable and as though they are maximizing it, as long as they obey certain axioms. And if I just quickly run through them, although as I said, let's not worry about them too much. They're usually discussed in the context of not individual products, but bundles of products. If those bundles of products are A and B, if A is one set of goods that you can buy over a period of time and B is another set of goods, the axiom of completeness means if you are choosing between two sets of goods, A and B, you should be able to say whether A is preferred to B is preferred to A, or whether you're indifferent between them for every pair of bundles. So for every choice available to you, you should be able to say which option you prefer, or whether you're indifferent. Secondly, under the same circumstances, you should always make the same choice, so you're behaving consistently. Thirdly, if A is preferred to B, and if B is preferred to C, then C can't be preferred to A. That's called transitivity, in order to be behaving rationally. And fourthly, if A is preferred to B, and both A and B are preferred to C, then including C as an option should not reverse your preferences between B and A. There is a video of Dan Ariely doing a TED Talk, the author of a book called Predictably Irrational, which I share at the end of slide 20, where Dan Ariely shares some entertaining and interesting real-world examples of where this axiom of independence or doesn't apply. One of the examples relates to purchases of The Economist magazine, or the way The Economist magazine is advertised. So take a look at that by all means later on. But basically, option C is a terrible option. You're never going to choose it. So if you start off choosing between A and B, and you prefer A to B, then adding this third option that you'd never choose shouldn't change your preferences between A and B. That's what independence in this context means. Okay, well, if you obey completeness, consistency, transitivity, and independence, then it's fine for us to model your behavior as though you are maximizing your cardinal utility, even though cardinal utility doesn't actually exist. If the above axioms are obeyed, then the individual behaves as if maximizing measurable utility, even though utility itself cannot be measured. How do we, under these circumstances, identify what should maximize your utility as an individual? Well, we kind of reverse cause and effect here. The choices of the individual reveal what maximizes their utility, hence revealed preference theory. If you choose to purchase a set of goods, then that choice is by definition optimal as far as you're concerned. It is a utility maximizing choice rather than your preferences defining what you buy. What you buy reveals your preferences. in Paul Samuelson's theory. All that has to be true for you to be regarded as a rational utility maximizing individual is for you to behave consistently over time. That's basically what the axioms on the last slide were all about. If you then allow for a change of preferences over time, you can go further and you end up defining virtually any behavior as rational, which is a rather empty approach to thinking about what motivates human behavior. Under cardinal utility theory, preferences define choice. In revealed preference theory, choices reveal preferences. What you choose must be what is optimal for you by definition. Somewhat weird in that consistent behavior surely should not be our definition of what it means to be rational. You can consistently go around seeking to murder everybody over time. Is that what we define as rational behavior? Anyway, I don't want to go any further into that, but that's revealed preference theory for you. So far, we haven't brought probabilities into it. We've been talking about decisions made under certainty. If we want to think about decisions made under conditions of risk, these were initially analysed by the people who began the development of probability theory during the period of the Enlightenment with reference to gambles. Pascal began the development of probability theory. To Pascal, a rational decision maker would always take the action with the highest expected payoff under conditions of risk. In other words, where all the possible outcomes of a decision could be identified and where the probabilities of those outcomes occurring were also known or could be estimated. According to Pascal, if you're faced with a choice between two lotteries, A and B, where A provides a 10% chance of winning $1,000 and a 90% chance of winning nothing, and B provides a 40% chance of winning $200 and a 60% chance of winning $20, you should choose lottery A. This is because the expected value of lottery A is higher than the expected value of lottery B. To get the expected value of the lottery, you take the possible outcomes and you multiply by the probability. So the expected value of lottery A is 1,000 times 0.1, 10% chance of winning $1,000, plus 0 times 0.9. Of course, that becomes 1,000 times 0.1 or $100. The expected value of lottery A to you is $100. As far as lottery B is concerned, then you've got a 40% chance of winning $200, so you do 0.4 times 200, and a 60% chance of winning just $20, so you do 0.6 times 20, and that's all the things that can happen. That's why the probabilities add up to 1. And when you do that sum, 0.4 times 200 gives you 80, 0.6 times 20 gives you another 12. You get an expected value from lottery B of $92. The expected value of lottery A is $100. The expected value of lottery B is less than $100. So as a rational decision maker, as far as Pascal was concerned, you should choose lottery A, not lottery B. Anyone who chose lottery B, from Pascal's perspective, would have been defined as being irrational. Pascal even applied this logic to the decision of whether to believe in God, absurdly, defining it as a rational decision, as though you can decide whether to believe in God or not. Because if you choose not to believe, well, whether God exists or not, in Pascal's view, there's a zero payoff to you. But if you choose to believe, if there's even a small probability God exists, that's a non-zero probability times a huge payoff to believe. So there is a positive expected return to believing in God. So logically, you should believe in God. That was Pascal's view of rational decision making, or even that is a decision that you can consciously take. Pascal said nothing about utility. Utility, expected utility, and risk aversion are to be found in a 1738 paper by the mathematician Daniel Bernoulli. Virtually the whole of the modern neoclassical theory of decision-making under risk, which is the foundation of modern portfolio theory, which I've taught myself many times in investment theory classes down through the decades, was in that paper in 1738. 1738, remember, it wasn't until 1776 that Adam Smith published The Nature and Causes of the Wealth of Nations. This is very early, and in some respects, it anticipates the development of mathematical approaches to economics by over 100 years. Bernoulli wanted to explain why a rich person might be more prepared to take a risky bet than a poor one. So why a lottery ticket giving you a small chance of winning a large sum of money might be worth more to someone who was already rich than to somebody who was poor. And also a puzzle that I'm not going to dwell on now, but you can look up for yourself, that had been set by his cousin, Nicholas Bernoulli, called the St. Petersburg Paradox. I deal with both of these in the chapter of my book. I'm not going to deal with both of them now. The answer lie in the concept of utility and marginal utility, and particularly a diminishing marginal utility of wealth. If you are that poor person, you've just got a few dollars. Let's say you've got $100. That $100 is incredibly important to you if that's all you've got, because it's going to keep you alive in the near future. You are going to be extraordinarily risk averse. You are going to be extraordinarily reluctant to give up the $100 or a significant part of it for a small chance of an even very large sum of money, because of the consequences of that small chance not happening and you ending up with nothing. If you are someone who is already rich, then losing $100 really is not all that significant as far as you're concerned. So you'll be much more prepared to put that $100 into a lottery where the payoff might be a very small chance of getting millions of dollars in return. It's because the marginal utility of the last $100 of wealth for you is much lower than the marginal utility of the first $100 of wealth to somebody who only has $100. So the diminishing marginal utility of wealth explains differences between the degree of risk aversion, of a willingness to take a risk of these two decision makers. And Bernoulli explained this, as I've said, in a paper called Exposition of a New Theory on the Measurement of Risk, which was published in an economics journal, Econometrica, in 1954, but that was a reprint. The paper was originally written and published in 1738. This is what he wrote in 1738. Here's a chapter from the paper. To make this clear, it's perhaps advisable to consider the following example. Suppose a very poor fellow obtains a lottery ticket that will yield with equal probability either nothing or 20,000 ducats. Well, we know what the expected payoff in ducats is there. It's 10,000 ducats. Will this man evaluate his chance of winning at 10,000 ducats, which is basically what Pascal would have said? To me, it seems that the answer is in the negative. On the other hand, I'm inclined to believe that a rich man would be ill-advised to refuse to buy the lottery ticket for 9,000 ducats. In other words, somebody who's very rich might assess the value of this lottery at something close to its expected financial payoff. If I'm not wrong, then it seems clear that all men cannot use the same rule to evaluate the gamble. Anyone who considers the problem with perspicacity and interest will ascertain that the concept of value, which we've used in this rule, may be defined in a way which renders the entire procedure universally acceptable without reservation. To do this, the determination of the value of an item must not be based on its price, but rather on the utility it yields. The price of the item is dependent on the thing itself and is equal for everyone. The utility, however, is dependent on the particular circumstances of the person making the estimate. Thus, there is no doubt that a gain of 1,000 ducats is more significant to a pauper than a rich man, though both gain the same amount. The rich man is more prepared to pay 1,000 ducats for a lottery ticket than the pauper would be. Bernoulli illustrated this mathematically with a utility equation. We say a utility function. That word function just is another name for equation, really. It says what is on the left-hand side of the equation depends on or is a function of what's on the right-hand side. Bernoulli wanted a function for the total amount of utility or satisfaction you enjoy from life, where total utility depended on wealth, but with a diminishing marginal utility. And you get this if you just use a logarithmic function where utility is a log of wealth. Modern day microeconomists, neoclassical microeconomists, use a different mathematical form for reasons we won't worry about, but it basically gives you a curve which is the same shape as Bernoulli's utility function. As your wealth increases, your total utility increases, but it increases more and more gradually. The gradient of the curve gets less and less. We say it's a concave function. There is diminishing marginal utility. And this diminishing marginal utility is enough to, or is the same concept actually as risk aversion. And I can illustrate that very briefly. If we say on the horizontal axis, I haven't put a scale there, but say every step here is $10,000, let's say. And then on the vertical axis, every step is 10 utils. If you have no wealth, you have no utils. If you have $40,000 of wealth, it looks like you're going to have, say, about 38 utils. If you have $20,000 of wealth, you're going to have, maybe 33 utils. So the first $20,000 of wealth give you 33 utils. Another $20,000 of wealth only increase your utility by about 5 utils. We have a diminishing marginal utility of wealth here. As far as risk aversion is concerned, imagine facing the following choice. You either take $20,000 of wealth for sure, which gives you, as I just said, 33 utils, or you have a gamble where there's a 50-50 chance of you having zero wealth or having $40,000 worth of wealth. If you have $40,000 worth of wealth, you get 38 utils. If you have zero wealth, you get 0 utils. If we were to calculate the expected utility of that gamble, it would be 0.5 times 38 utils plus 0.5 times 0 utils. It would be about 19 utils. That's where you can see me indicating with the arrow here. So the expected utility of the risky gamble, which after all has an expected wealth of 20,000 utils, is far below the utility that you will enjoy if you have 20,000 utils for sure, which was on the blue curve. There was, on the scale we've got here, about a 14 util gap between them. That gap is a measure of the risk aversion of the decision maker. Our decision maker would turn down this bet, would prefer to have $20,000 for sure, rather than a 50-50 chance of nothing or $40,000. As you move further up the utility function, those vertical gaps, if I was to imagine starting with 100,000 utils and then imagining losing or gaining 20,000 utils from there, get less and less. Our decision maker becomes less risk averse as the initial wealth of the decision maker increases. And this is the same thing as saying that our decision maker has a diminishing marginal utility of wealth. A falling marginal utility of wealth and risk aversion are the same concept. That Bernoulli explained, nearly 300 years ago. An amazing advance in logic. Rational behavior in Bernoulli's theory becomes taking decisions to maximize your expected utility. That's not the same thing as maximizing your expected wealth. Where utility depends on wealth, then rational decision makers should maximize expected utility. How do you do that? Well, you take those decisions, whether we're thinking about gambles or whether we're thinking about investments or other decisions you might take, if your utility depends on your total wealth, by identifying all the possible outcomes from a particular decision that you have taken as far as your wealth is concerned, calculating how much utility you would have in each of those outcomes, multiplying by the probabilities of each of those outcomes arising, and adding them up. Don't worry too much if your mathematics is not that strong at the moment. I'm not going to be asking you to do any maths in this subject, but you have to bring in a little bit of mathematics to explain what expected utility theory is all about. We're taking into account your utility, your risk aversion, how likely a variety of outcomes are to actually happen from your perspective, given your time horizon for any set of investment decisions you're taking at the moment. And you're supposed to consistently make decisions in such a way that maximizes not your expected wealth, but your expected utility. This and the assumption of a diminishing marginal utility of wealth, or the assumption of risk aversion, is the foundation of the modern investment theory on which decisions on financial markets are supposedly based. If you are risk averse, you'll require a risk premium on more risky assets as an inducement to overcome your risk aversion. So investors will require a higher average rate of return over time on the stock market than they get on their bank deposits if they're going to overcome their risk aversion and put money into the risky stock market, because the stock market, as we know, can go down as well as up over time. Expected return is good. You like the fact that shares provide you with a higher return than your bank does. Risk is bad. You don't like the fact that shares are risky, whereas money in your bank should be safe. You'll trade off, though, risk against expected return. If you were risk neutral, you'd always select the investments with the highest expected financial return, regardless of risk. You would be like Pascal's decision makers. Only expected return would matter, risk would not. If you were a risk seeker, you might actually choose lower expected return investments, even if there's even a small chance for a big payoff. And actually, people behave as risk seekers when they buy lotto tickets, don't they? Because when you buy a lotto ticket, it has a negative expected return. The chance of you losing your money is almost 1. There's a tiny chance that you're going to get a large amount of money back, but when you multiply the payoffs by the probabilities, you come out with a minus figure. So if you still choose to buy that lotto ticket, you're not behaving as a risk-averse individual. You're not behaving as a risk-neutral individual. You are like somebody going into a casino. You're playing a game of chance with the odds stacked against you because there's just a tiny chance that you'll win big. By the way, if people were consistently risk seekers, instead of there being a diminishing marginal utility of wealth, to make sense of that in neoclassical economics, we'd need an increasing marginal utility of wealth. We'd need the curve to be shaped the other way. Modern expected utility theory is based on a set of axioms similar to those of Samuelson, which means people would act consistently as though they were maximizing expected utility, even though utility can't be measured on a cardinal scale. These were developed by von Neumann and Morgenstern, who also invented game theory in 1947 for objective probabilities, and Milton Friedman and another economist called Savage in 1952 for subjective probabilities. As with revealed preference, by offering people choices, this time under conditions of risk, and observing behavior, you should be able to identify an individual's preferences. This time you can identify their degree of risk aversion. If we imagine people will make realistic decisions under laboratory conditions, you can sit them in front of a computer, you can give them a variety of investments or gambles to choose between, and by assessing the choices that they make, you'll be able to identify precisely how risk averse they are, at least in principle. The trouble is, when economists started doing this, they discovered people were not behaving as economic theory said they ought. They were not following those axioms of Samuelson and von Neumann and Morgenstern and Friedman and Savage. And so the theories of Bernoulli and, if we want to go all the way back, Bentham, don't seem to describe real humans' decision-making, at least not consistently. For example, it may be the case that your own personal behaviour is sometimes risk-averse and sometimes risk-seeking. It might be that you sometimes behave like someone in Bernoulli's theory with a diminishing marginal utility of wealth, and sometimes someone with an increasing marginal utility of wealth. Well, that would tend to imply that the whole of utility theory and expected utility theory is somehow fundamentally flawed and needs to be replaced by something else, wouldn't it? Well, let's just think about my behavior. If I invest in shares rather than just leaving my money in the bank, I require a risk premium. Absolutely. Well, what am I doing there? I'm looking, if I invest in shares, I'm evaluating gains on those investments that are highly likely to occur, but where there is some degree of risk. I require a risk premium. I'm risk averse. I'm also risk averse in some other areas of life too. When we're looking at low probability losses, I insure my house against theft. I insure my house against it burning down. This, hopefully, even with climate change, is still a relatively low probability event, but I pay a premium for that insurance. Now, the expected value of that investment to me financially is negative. That's how come the insurance company can make a profit over time. What they take in from people like me in premiums is much greater than what they pay out to people whose houses actually have burned down. That's a positive expected value for the insurance company from those contracts, negative expected value from me. Why am I prepared to pay such a high premium to insure against such a low probability event? Because I'm exhibiting risk-averse behaviour. But on the other hand, I go into the newsagents and I buy lotto tickets. That's risk-seeking behaviour. What am I doing there? I am taking a big risk. I'm actually engaging again in a negative expected value investment, but I'm doing so not to avoid a risk. I'm doing so to expose myself to a risk to the very low probability that I'll actually win and become a multimillionaire. And were I to go and get a job as a fund manager for in a financial institution, I would find that they would impose position limits on me in order to try and avoid me engaging in highly inappropriate risk-seeking behavior when I had started making losses as a result of recent investments I'd engaged in. In the past, there have been cases of fund managers actually driving large, well-established financial institutions towards insolvency by engaging in such behaviour. It happened to a British investment bank called Barings way back in the 1990s. What happens here? You've made some losses already. You're like a gambler in a casino that's already lost nearly all your money. And so you keep doubling up. You keep taking more and more and more risk, even though it's highly likely that you're going to make even bigger losses just because there's a small chance of somehow being able to claw your way out of this disastrous situation that you're in. You're engaging in risk-seeking behavior here. So the same people, or the same kind of people, are sometimes risk-averse and sometimes risk-seeking. They don't behave consistently in different contexts in terms of their attitude to risk over time. How do you explain the same person being highly risk-averse where investments and insurance are concerned, but apparently risk-seeking when faced with a high probability of losses or visits to a casino? We will consider a possible solution. It would involve a psychological theory of decision-making and well-being called prospect theory, but it won't be expected utility theory. There is no, there are various attempts there have been to try and make all this observed behavior consistent with the neoclassical theory of optimal rational behavior, expected utility theory, but none of them are at all persuasive. You and I will find a possible solution to these apparent anomalies with expected utility theory, but it won't lie in expected utility theory itself. We'll mention Matthew Rabin, a behavioral economist, in our next set of slides. Richard Taylor, I've already mentioned, a Nobel Prize-winning behavioral economist. Daniel Kahneman, another Nobel Prize-winning behavioral economist, author of the book Thinking Fast and Slow, which is what I'm referring to here. Well, quoting Rabin and Taylor, Kahneman wrote, "It is time for economists to recognize that expected utility is an X hypothesis." Of course, they are referring there to Monty Python's dead parrot sketch. This is an X-parrot. It has ceased to be. It really should have been ceased to be. It has no business sitting there, as it does in the first equation of most modern macroeconomic models. Most modern macroeconomic models, including those that are used to analyze economies in treasuries and central banks around the world, have equation one. There's a representative household, and that representative household is assumed to make decisions today, looking into the distant future to maximize its expected utility. Taylor and Rabin are from the branch of new behavioral economics, which is most sympathetic to neoclassical economics. We're going to talk about the views of people like them and Daniel Kahneman next. Then after that, when we've reminded ourselves about the nature of fundamental uncertainty in Keynesian economics, we're going to have a look at someone closer to Herbert Simon, a modern day behavioral economist who you wouldn't describe as a new behavioral economist, because his approach to criticizing expected utility theory is much more fundamental and much more consistent with a genuine paradigm shift in economics, and that's Gerd Gigerenzer. Meantime, you could have a look at some pages of my book, which are referred to here, or I just checked before I did this talk, the Bernoulli's paper via Econometrica is also available through the library if you want to go and take a look at that too. But that's it as far as this session is concerned. Very long one.